A very good morning, friends. So I hope you're all doing well. And of course, as I had requested and insisted, I would say that you made a revision of what we covered in the previous session. Though I also promised that, as we go to start, I'm just going to take a quick mind map in terms of the coverage in previous sessions as well. So that we keep, making our cumulative revision as well. But nevertheless, that also means that you need to also do your bit as well. Because once you hear things after the revision is done, you get the dots connected more clearly. So on the presumption that you've made your revisions on what we covered in the previous session, I'm just going to give you a quick recap in a couple of minutes, revising in terms of what we have covered on financial instruments so far. You can take this note as well because this is a kind of a mind map, which I always tell people that you should make some mind maps for your quick revisions in the last time. Because you've written all the complete details, notes at one place, but then it's very difficult to, remember the voluminous notes at the last stage. So you need some quick, notes to revise them at the end. So I think what I'm going to do, I'm just going to make a quick mind map of the learnings. Well, of course, not all points will be put across in this mind map, but this will contain more or less the complicated discussions we had. I think just to remind you that in terms of financial instruments, we said there are three standards. I'm not putting that in the mind map. So we know one is Index 32, which talks on presentation in the balance sheet, typically from the issuer perspective. Then there is Index 109, which talks of typically the accounting, the recognition, and the measurement aspect. How do you measure the financial assets and liability initially and subsequently at each balance sheet date? And then it is Index 107, which talks of the disclosure requirements pertaining to the financial instruments, and that goes in the notes to accounts. A basic input started on with the very first input that we are looking at the presentation. We're looking at the presentation, you can say, of financial instruments, and that is typically from the issuer point of view. So our focus was the presentation of the financial instruments, and that is typically from the issuer point of view, and this presentation is in the balance sheet of the issuer. Taking a call and deciding that do we present this as equity instrument? Do we present this as a financial liability? And now we've also decided that is it a compound financial instrument? So I'm yet to give you the presentation in the balance sheet. I will be coming to that part also very shortly once I come to the compound financial instruments. But we decided that when you present the instrument, it is either presented as an equity instrument or as a financial liability, or it is presented as a compound financial instrument. I think I'll say something in words at the moment, but I'll connect you the data once we come to the compound financial instruments. Now just hear this carefully. I'm not documenting this at the moment. If you say the instrument is equity instrument, it gets presented under the equity section, equity share capital. If you say it is a financial liability, it gets presented under non-current liabilities, financial liability, borrowings in the balance sheet. I'm talking of the presentation in Schedule 3, Division 2 of the balance sheet. So mind the words. So when you say that it is an equity instrument, it gets presented under equity share capital. When you say it is a financial liability, it goes non-current liability, borrowings, and you've got financial liabilities within borrowings. Or you can say financial liabilities followed by borrowings. But when it is a compound financial instruments, what we're going to learn today, we're going to split the proceeds collected in terms of liability and equity. How do we do that? That goes later. But the proceeds which are collected by the issuer is going to be split in terms of two components. One is in terms of liability, financial liability, and the other is equity. The financial liability component is going to be presented in the balance sheet, same borrowings in the balance sheet. But the equity component segregated will go in the equity section, other equity. So mind you, here the equity goes under equity share capital, and here the equity goes under other equity. Don't worry, we'll talk about this later as well, because our focus is on the presentation. So we need to clearly see the presentation of the instrument in the balance sheet. I just wanted to tell you something early in the morning. We'll come back to those agendas of presentations when we discuss the compound financial instruments accounting in detail, because the accounting of a compound financial instruments is given basically in Ind AS 32. So we're going to talk of that, no worry. Okay, and for this particular purpose, what I gave you, that in this particular case, we are going to apply a three-step model in terms of taking a decision. So we decided that we're going to apply a simple three-step model in terms of deciding, is it equity, is it financial liability, or is it a CFI, that is a compound financial instrument. And for this particular purpose, I give you a three-step model. We just take down some quick inputs in terms of what we learned on the three-step model. So I give you certain focus points under each of these steps. And if you recall, the very first step focuses on obligation is contractual in nature. So when you look at the step number one, you need to see that the obligation of the issuer is by way of contract. So we can say it should be a contractual obligation. And I think that is the key word. For example, I said that if you're liable to pay taxes to the government, it is an obligation, but it is a statutory obligation and it's not by a contract. So if you want to bring it under the purview of financial instruments, you need to prove that the obligation is by way of contract. Let me also tell you, though I might not have said that in the last time, remember when you do the concept of Ind AS 37 provisions, contingent liability, you would remember that in that particular standard, you say the obligation can be by contract, it can be legal, or it can be constructive. I'm taking you to the difference in terms of the wordings. In terms of Ind AS 37, you say it's legal or it is constructive. Now, when you use the word legal, it's a little larger word, because legal obligation includes by law. Legal obligation includes by contract. So Ind AS 37 focuses on the concept of a legal obligation. It covers both by law as well as by contract. But when it comes to Ind AS 32, remember, it's not covering the obligation by law. It's covering an obligation which is by contract. So you can say Ind AS 37 focuses on the larger obligation word, legal, which means by law as well as by contract. But when it comes to Ind AS 32, the focus is only obligation by way of contract. So your first focus would be to see that as an issuer, you've got an obligation which is by contract. Second, when we went to the second step, we said the crucial input is not to decide by a name. You're not going to decide by a name, but you're going to decide by the mode of payment. It is the mode of payment which is the crucial factor to decide. The instrument is own funds, equity, loan funds, liability, or maybe a blend of the two, which is a compound financial instruments. And we said, when you consider the mode of payment, in this particular case, we said the mode of payment could be cash, or the mode of payment could be in terms of shares. A company uses its own shares as a currency note. The company uses its own shares as a currency note to discharge the contractual obligation. Now, we decided that once you say the mode of payment is cash, you need to see certain generic terms and then decide. I'm talking about the version number 2. The version number 1 stands scrapped. So I gave you that when you're focusing on the mode of payment being cash, what you need to see, you need to consider, are we looking at the return component, the interest and dividend? or we're looking at the principal component and then take a decision. And we said, if you're looking at the return element, you're going to see words like mandatory, you're going to see words like discretionary. So the moment the mode of payment becomes cash, your mind starts working on the terminology mandatory, discretionary, because you need to prove that if it is a financial liability, there is an unavoidable obligation to pay. So when you say it is mandatory, it becomes a financial liability. When you say it is discretionary, it becomes an equity instrument in that case. Similarly, when you're focusing in terms of the principal component, you need to see the words, is it redeemable or is it irredeemable in nature? Redeemable means that after a certain fixed tenure, the money is going to be paid, and therefore there is an unavoidable obligation to pay. So if it becomes redeemable in nature, it becomes a financial liability, and if it is irredeemable, it becomes equity instrument in nature. Though I think I also told you that I'm going to talk more of the perpetual debentures. One of the illustrations was pending, and I said I come back to the illustration. So we're going to make our discussions today on the irredeemable, or you can say the perpetual. Rather, I would call it as a perpetual debt. So we'll see a little more intensive discussions on the concept of a perpetual debt. And when you say that the mode of payment is shares, you go to the step number 3, in which case the focus is just on the number. The focus gets just on the number. That is it supposed to be a fixed predetermined number of shares, or is it something which is going to be variable and decided at a later stage? And we said that if it is a fixed number of shares, it becomes an equity instrument, and if it is variable, then it becomes a financial liability. So I think in this particular case, you can definitely relate in your mind. The moment the mode of payment is shares, what goes in the back of the mind is fixed and variable. The moment it is cash, what goes in the mind is the 4 generic terms: mandatory, discretionary, redeemable, and irredeemable in nature. Our journey did not end at this particular stage. We went ahead as well. So I hope you're taking notes of the input as well. And let's also give you some more data. Then after this particular discussions, we went to our third area of discussions. And I introduced to you that I need to go for the version number 3, which I'm going to give you today. And for this particular purpose, I said you need to get knowledge on the concept of derivatives. So I introduce you to the concept of derivatives on a very basic level without getting into nitty-gritties. And I said, when you're looking at the concept of derivatives, Index 109, not 32, but Index 109 gives you all the features which you need to meet before you can call any contract or instrument as derivative in nature. And we decided that there are a total of 3 features. So in order to say that it is a derivative contract, we've got 3 parameters. And we decided that you need to meet all these 3 parameters before you can say that yes, it is a derivative contract in nature. And in this particular case, we said the first feature is that the value is derived. The value is derived from an underlying asset. The value is derived from an underlying asset. The derivative is not taking its own value independently. The derivative is not taking its own value independently, but the derivative is deriving its value, you can say, from another underlying asset. And then we said the second feature is that there is nil, or you can say negligible, initial investment. So we need to see that the investment which is done initially is either 0 or it is negligible in nature. And then we said that there is going to be a future settlement. And unless and until you say that there is a future settlement, you cannot say it is a derivative. And we said all these 3 parameters need to be met. If you fail any one, it's not a derivative under the purview of financial instrument standard. Now, we also came to the inputs in this particular case that when you look at derivatives, there are certain common examples. I said there are certain common examples of derivative contracts, and we said the common examples are, you can say that there could be a forward contract. We said there could be a futures contract. We said there could be an options. I gave you some basic inputs on a forward contract as well as in terms of options. We'll talk more of options later. And we said that there are swaps as well. So these are the kind of most common derivative contract. Now, why did I give you the inputs on the derivative contract? Now, I think that's the important agenda. Because in my version number 3, this is what I'm going to introduce. So please now hear me very carefully. I said that last time as well, but I want to put this once again very clearly before we proceed with our thoughts. When you're looking in terms of a financial instrument, when you're looking in terms of a financial instrument, I would say the financial instruments can be segregated in 3 broad categories. I'm not talking of FL equity or in terms of CFI. That's, the second layer. The first one is when you look at any financial instrument or a contract, is it non-derivative in nature? That means it has got no derivative content. The instrument is purely a non-derivative. In fact, all the illustrations which we did in the study material the other day is all contains the concept of a non-derivative instrument. I know you must be now thinking, sir, am I supposed to now decide when I look at a question that is a derivative or non-derivative nature? No worries, I'll come to that part. I'll very soon come to that part. So, but I want to tell you that the instrument could be non-derivative in nature. It could be a derivative in nature, or it could be a mix of a derivative, non-derivative. So before, mind these words carefully, before you decide that the instrument is equity or a financial liability or a compound financial instruments, yes, more or less you can say, I need to decide first of all that is it a derivative, is it a non-derivative, or is it a mix of derivative and non-derivative? So you can say that when you look at financial instruments, it could be of 3 categories, that is non-derivative in nature. Or it could be something which we can say is derivative in nature, or it could be non-derivative plus a derivative combined. It's called a mix. Now, what you need to understand and appreciate in the last one is, this is what we technically call, this category is what we technically call that there is an embedded derivative in the financial instruments, because it is an instrument where a derivative is embedded. You can say included in simple words. So this is what we call embedded derivative. The standard Index 109 gives you a typical accounting of how the derivative is to be, segregated out of that instrument. Get the meanings very clear. So now our focus is going to be looking at the instruments from this perception. And once I've seen them from this perception, then I will decide, is it financial liability, is it equity, or a CFI? Wow, let me just connect the dots of the last one input. So far what I've done, I've basically given you quick revisions of what we covered in the previous session. And as I said, before we start, we'll just connect the dots. I'm pretty confident that if you made the revisions on what we covered in the last class, you must have enjoyed the initial bit, that everything would have got bundled in your mind. Now let me just connect the new inputs which I've given you in the last few minutes on this standard. So far, we've been looking at financial instruments. All the illustrations, they were non-derivative. So, but we never made an evaluation. How do we know that it was a non-derivative? Don't worry. Now we know the 3 parameters when it is a derivative in nature. So which means now onwards, I am going to first of all look into an instrument and see, is it a non-derivative? with no derivative elements? Is it a pure derivative with no non-derivative elements? Or is it supposed to be an instrument which is both derivative and non-derivative? And that's called that there is an embedded derivative in the instrument. Because the standard in Index 32 gives you a different lens. It gives you a different methodology in terms of deciding that the instrument is equity or financial liability if it is non-derivative, if it is derivative in nature. I hope, friends, you got the dots connected. You got my thoughts very clear on this. Correct? So do let me know if there is any questions coming to your mind so far. I hope I have made myself pretty clear on the agenda that when I am looking in terms of the financial instruments, we've got a total of 3 categories to go with. Okay, so far so good. So I think now I am going to take the journey forward with you. Okay, so we're just coming back on the agenda out here, and I want to now give you the inputs. I'm going to first of all give you the inputs of how does my 3-step model change. Well, hear this carefully. I'm going to give you the inputs. How does my 3-step model change if it is a derivative, if it is a non-derivative, and if it is supposed to be, a case of embedded derivative. So hear this carefully, then we'll see examples after this. Let's take it further. Now I am coming back to the 3-step model which I gave you. I'm coming back to the 3-step model which I gave you, and this is the version number 3. And this is the version number 3, the final version. We are going to apply only the version number 3, not the version 1, not the version 2. So now we are on the version number 3, which is the main and the final version, with the help of which you will take decisions. Now, hear me carefully. There is no change in terms of step number 1. I'm talking of the version number 2 and the version 3. There is no change in step number 1 and in step number 2 in terms of version 3. The version 1 and the version 2 and 3, step 1 and 2 remains the same. Now, I'll still document that, so that there is no confusion, because this is a final version. So my step number 1 does not undergo a change. I am going to put across a question, does the issuer? I'm going to put across a question, does the issuer have a contractual obligation? So we're going to put across a question, does the issuer have a contractual obligation? So no change in terms of the very first step. So the focus is on the contractual obligation. So does the issuer have a contractual obligation? And the answer could be a yes, and the answer could be a no. If the answer is a no, we've already seen that the standard is not applicable. But if the answer is a yes, we're going to go to step number 2. So no changes in step 1. I'm just still documenting them on a very safe side. So when you revise, everything is at a single place with you. But when you're going to revise, you're going to slowly and steadily reach that consolidated point. Now, we go to the step number 2, and now we focus on the mode of payment. We focus on the mode of payment. And I will say something at this end, because that's going to be very important in terms of evaluating the question. So the mode of payment, as we said, is either cash, or the mode of payment is, let's say, shares, but not anything else. Now, if your mode of payment is cash, I am not going to decide is it derivative or non-derivative. Please hear me carefully. If the mode of payment is cash, I am not deciding the instrument is derivative or non-derivative. If the mode of payment is cash, I will directly decide with the help of the chart, mandatory, discretionary, redeemable, irredeemable. You don't need to decide is it derivative, non-derivative in nature. So the focus needs to be clear that in terms the mode of payment is cash, I am simply going to decide with the help of the terms. So let me, I think, put this across. So if the mode of payment is cash, there is no need, to decide. There is no need to decide that is the financial instrument supposed to be derivative or non-derivative in nature. We don't need to decide all that. We don't need to decide all that. So the focus needs to be clear in which layer are you going to take a decision. So when you go to look at the question, you need to carefully see, okay, the mode of payment is cash. Let's not get worried. We're not supposed to decide it is derivative, non-derivative, because the standard does not make a distinction between the case of a derivative, non-derivative. If the mode of payment is cash, the parameters to decide remains the same. There is no decision separate. So in this particular case, what do? You simply take a call and decide that if it is mandatory or is it discretionary. And you decide on the basis it is redeemable or it is irredeemable. And if it is mandatory, it's a financial liability. If it is redeemable, it's financial liability. If it is discretionary, irredeemable, it becomes an equity instrument. So no need to take any decisions. I hope I stand very clear on my thoughts. So the moment your mode of payment becomes cash, don't get worried. No need to decide, is it derivative, non-derivative? Let it be. Now, when you say that the mode of payment is shares, we go to the step number 3. I've just given you one simple clarification. Otherwise, the step 1 and the step 2 remains the same. So don't get worried on how you're going to think. We will go to the illustrations and have a look at how do we capture, how do we decide. If the need be, we'll maybe revisit those illustrations which I've shown you, because in those cases when the mode of payment was shares, we never decided it's derivative, non-derivative. So now wait. Let's now go to the step number 3 in this particular case. Now comes the change. Now comes the change. If the mode of payment is shares, before you decide anything, you need to decide, is it derivative or non-derivative in nature? So the role of whether a contract instrument is derivative or non-derivative comes into play when the mode of payment is shares. So the moment you go to the step number 3, before you decide it is fixed variable, no, you need to decide, is it derivative or non-derivative in nature? So in this particular case, what we'll do, at the first instance, you will decide the nature of the instrument. You will first of all decide the nature of the instrument, and in this particular case, we'll see that is it non-derivative in nature. Now you would say that if it is both derivative, non-derivative, don't worry, we'll see that later. But for the time being, we're saying that the two permutations combination. So in the third step, you will first of all decide, is it derivative or is it non-derivative in nature? So the concept of a derivative and non-derivative comes into play only when the mode of payment is shares. And how do you decide derivative, non-derivative? You know that there are those 3 parameters which I gave you. And if those 3 parameters are met, it is derivative in nature. And if those parameters fails, and one or more of those parameters fail, it becomes a non-derivative in nature. Now, see this carefully. Once you decide that it is supposed to be non-derivative, we will apply what is called a fixed test. We will apply what is called a fixed test. I did not take this name earlier. I only told you that C is the number of shares fixed or variable. I just gave you the input C, that is the number of shares fixed or variable. That is called the fixed test. We're giving it a nomenclature now that is called a fixed test. If it is non-derivative, we will apply the fixed test in which you will see that is the number of shares. You need to see that is the number of shares to be issued. Is the number of shares to be issued predetermined, that is fixed, or it is not predetermined, that is variable? So this part of the this part of the analysis remains exactly same. This part of the analysis remains exactly same, except that I've given you a new nomenclature that you're going to apply what is called a fixed test. If you say it is fixed, then it becomes equity instrument. If you say it is variable, it becomes a financial liability. I've just added a name of the test. That's it. I know we must be getting a little more technical today. Yes, of course. So as we progress class by class, is the level of financial instruments going to increase? Yes. But if you keep doing your cumulative revisions and you hear the inputs carefully, trust me, it's not difficult. It's going to be enjoyable. You're going to love the concept because you're going to get some technical knowledge. You're going to get some enhancement in your minds as well. Okay, so now coming back to the input, if you say it is a derivative, the standard gives us a new test. If you say that it is a derivative, you cannot apply a fixed test. They've given a new name. Now let's not get worried. Don't get worried on the nomenclature. How do we apply? We'll see. We'll see. I'm just giving you the concept. So it is called fixed. It is called fixed for a fixed test. The name of the test undergoes a change. The name of the test undergoes a change and it is called fixed for a fixed test. We sometimes call this as F for F. It is called fixed for fixed. Sometimes I'm going to use the short form. It's called F for F. Fixed for a fixed test. Now, what is this fixed for a fixed test? We'll see. We'll see what is this fixed for a fixed test. We'll see that in detail. But in this particular case, there is a new test which has come into play. You're going to apply a fixed for a fixed test. So you can see one thing very clearly. So now the next 5-7 minutes are very crucial, friends. Please hear me carefully. Because you're going to get the conceptual bit in the next 5 minutes. So don't write anything. Just hear me carefully for the next 5 minutes. I'll pen down the notes very soon. When you're looking at an instrument is non-derivative, there is only one thing to be seen, which is fixed or not, and that is the number. I repeat. When it is supposed to be a non-derivative instrument, there is only one thing to be seen, that whether it is fixed or not, and that is the number. But when you see that the contract is derivative in nature, there are two things to be seen which needs to be fixed. There are two things to be seen which are fixed. One is the consideration and one is the number. Now you would say, what do you mean by consideration and a number? Don't worry, we'll come to that. Just first understand what is to be seen, and then we'll see how do we evaluate that factor. So when it is a derivative contract, you will see that there are two things which needs to be fixed. One is the consideration received, and one is the number of shares to be issued against the consideration. So when you're going to look at the fixed for a fixed test, we can say what needs to be seen is, one is you need to see the consideration to be received. The consideration to be received is that fixed or not, and the other one is to see is the number fixed or not. I'm sure you want me to give you some logics at this stage. Do you want me to give you a logic? Why did these standard setters decide on a fixed test for a non-derivative, looking at just a number? And why did they look into the two fixed, that is the consideration and the number being fixed, if it is derivative in nature, so we can understand the thought process more clearly in life? You need to say a yes or no, otherwise I don't give you the logic. It's a deal. You need to ask for it. That do you want to know the logic? That why is there a fixed test and why is there a fixed for a fixed test for the two different kind of contracts? I get the input. Yes, sir. We want to know this, of course. Okay, so I'll give you the inputs at that. Also, sir, logic for number derivatives in cash mode, why don't we look into that part? Okay, no worries. We'll give you that input as well. But let me first answer this part. So I'm just leaving it here. I'm just coming back. Now I've got some few logical questions to ask you. And you will be able to get the inputs in terms of the logic. So I'm putting that as that what is the logic of taking this particular test? Let me now ask you a few things and you decide on a logical level. Let's say I'm looking at a non-derivative contract. I'm looking at a non-derivative contract and I'm looking at a derivative contract. And I said the standard setters in this case said that we're looking at what we call a fixed test. And the focus is only looking at the number. In terms of a derivative, we said it is a fixed for a fixed test. And in this case, you're looking at the two things being fixed. One is the consideration. One is the consideration and one is supposed to be the number. Now, let me ask you a few questions, friends. Please think carefully, because I think as I put the questions, automatically the logics will flow in a couple of minutes. What is risky? Is the past risky or is the future risky? A very common question, nothing to do with accounting. So what do you think? What is risky? The risk is attached to the past, which has already happened, or is the risk attached to the future, which is yet to happen? And I think undoubtedly we get the answer that future is risky. Great. Now I'm going to put another 4 questions to you, and if you can answer this, you'll get the answer immediately on the logic. So I am looking at the consideration. I'm looking at the consideration and I'm looking at the number. I'm looking at the consideration and I'm looking at the number. Now tell me one thing. In terms of a derivative, the contract is yet to be settled in the future. So is the issuer yet to get the consideration or is already received the consideration? Is the consideration received or yet to be received? It is a contract to be settled in the future, so that means it is yet to be received. So is the consideration related to the future? Well, yes. Can I say the consideration in this case is related to the future? Of course, yes. Because in terms of a derivative contract, the consideration will be received in the future. There is no initial investment. There is negligible investment. So all the consideration relates to the future. So now imagine that if the consideration is received in the future, I will be issuing the shares against that consideration in the future. I will be issuing the shares against that consideration in the future. So are both the parameters relating to future? Tell me yes or no. That you're saying that I will receive a consideration in the future against which I will issue the shares in the future. Did you get the inputs? And if both the factors relates to the future, future is the uncertain. Remember that when we decided equity financial liability, everything was being decided on the basis of risk. The risk relates to the future. So when you're going to get the consideration in the future against which we will issue the shares in the future, both the parameters need to be evaluated to consider the risk factor. And therefore, we are looking at the consideration as well as the number. Now let's come back on the non-derivative. In a non-derivative instrument, for example, a company issued, let's say, debenture. A company issued a debenture. As an issuer, is the consideration already received or yet to be received? Tell me. Is the consideration already received or is the consideration yet to be received? Because when you're looking at a non-derivative, it's something like, a debenture issued by the company. So is the consideration already received or is it yet to be received? And that's right, it is already received. So is the consideration related to the future? No. But the number of shares to be issued against the consideration already received, of course, relates to the future. And what is risky is the future. I hope you got some dots connected in your mind. So you can see that, of course, there are two elements, but what is important to understand is in terms of a non-derivative, what relates to the future is just the number. And in terms of a derivative, what relates to the future is not only the consideration, but also the number as well. And in order to get the risk assessment done, you need to consider that anything which relates to the future is going to decide the risk element. And we need to decide that if it is risky or not. So in this particular case, when you look at a non-derivative, the standard setters had one clear idea in mind, that in terms of a non-derivative instruments, the issuer receives the consideration today itself. But it is only the number which is, futuristic in nature. And when you look at a derivative, it is a contract entered today, but the settlement takes place at a future date. So the consideration gets collected later. The number to be issued against it gets decided later. So we need to see both the elements. And let me now tell you, if both the elements are fixed, does this mean that the risk is now on the holder? Tell me, if both the elements are fixed, the consideration to be collected is fixed and the consideration. So as an issuer, I'm going to get a fixed consideration. I'm a happy man. And as an issuer, I'm going to give fixed number of shares. I'm a happy man. So indirectly, the risk is on the holder. Correct. So if the risk is on the holder, so if you pass the fixed for a fixed test, then it becomes equity. If you fail the fixed for a fixed test, then it becomes financial liability. Failure of the fixed for fixed test means that either one of them is variable or both. Let's say if the consideration is variable, number is fixed. The consideration is fixed, the number is variable, or both are variable. So it becomes a financial liability in that case. Tell me frankly, friends, did you get the logic? If you want, I can put that once again, but did you get the logic? Tell me. I've given you the inputs of why does the standard setters tell me in this case. Did you get the logic in this particular case? I believe. Okay, so I think I got the inputs. Yes, we got the answer on that. And that is wonderful indeed. Last part of the explanation, you want me to put it once again? I'll put it once again. Let me correct the dots once again. Though, once we look at the practical illustrations, we'll understand the dots very clear. But let's understand one thing. When you look at a derivative instrument and a non-derivative instrument, we need to first of all understand with an example that what is the basic structure. So for example, if you enter into a future contract, for example, you enter into a forward contract. These are all examples of derivative. Now, let's say I went to the bank and I said, I'm looking at an example of a currency just for understanding as I gave you last class. I went to the bank and I said that I want to buy foreign currency in the future. So I enter into a forward contract. The bank tells me clearly that this is the rate at which I will give you the currency. This is the rate at which I will give you the currency. Now, let me ask you, is the rate they've decided fixed? Is the bank running any risk? They say, boss, if you want to buy $1 lakh 6 months later, you need to give me this rate of exchange. So is the money, is the consideration going to be received in the future? Is that fixed by the bank? In that particular case, is the bank running the risk or you are running a risk? Of course, you are running a risk in that case. So the bank is indirectly saying that I won't want to risk anything. You may be entering into a forward contract with me. So you pay me, let's say 80 rupees a dollar. So I'll give you $1 lakh and you pay me 80 rupees a dollar. So the consideration which the bank is going to get is fixed, and against which they will give you $1 lakh only. So which means they receive a fixed consideration in the future, mind the words. They receive a fixed consideration in the future against which they will issue a fixed number of dollars. Did you get the point? So which means the consideration to be collected on the contract and the number of dollars to be given against that contract gets fixed in nature. And if that gets fixed, so as a banker, I know I'm safe because I will receive a fixed consideration against which I will give you a fixed number of dollars. So whatever deal is going to occur in the future, I've made myself safe. I hope you got the connect. Now, let's go to the next one. A company issues a mandatorily convertible debenture. I'm just adding a new term. A company issues a mandatorily convertible debenture. Now, if you issue a mandatorily convertible debenture, in that particular case, if you say it is mandatorily convertible debenture, have you received the consideration from the other party? I said, okay, I'll give you debentures which will 100% be converted into ordinary shares at a future date. The fellow gave me the money today itself. The consideration is already collected. That's not futuristic in nature. And now I'm going to give him shares at a later date, and which may be fixed or which may be variable. And if it is fixed, it doesn't put me to a risk. But if it is going to variable, then it puts me to a risk. So in this particular case, the consideration is already collected, and what is collected does not have a risk. But it is only the number of shares to be issued against that convertible debenture is to be fixed or variable that would decide the risk upon the issuer and decide. So in this case, you can say, since the consideration stands collected, that's not futuristic, only the shares to be given in the future. So only look at one parameter, number. And in this particular case, when it is derivative, it is the consideration which is yet to be collected, and it is the number. So look at both the future elements, consideration as well as the number. Did you get my fundas clear? So tell me, friends, are you stand clear now on the concept of, if you remember, learn it, it's difficult. If you understand the logic, then you can always go back that, okay, in terms of derivative, the consideration number relates to future. So fixed for fixed test. And in terms of a non-derivative, it's just a number. So you just need to apply a fixed test. Okay, let me see if I got some inputs on that. Did you get the clarity of thoughts? So, but exchange rate could still change on the date of exercise, which can make it an element of risk to the bank. In case the bank, it says, in case the bank example, you gave. Now, you see, in this particular case, I understand that you're saying that there is a change which happens on the exercise date, but in any case, in a forward contract, no parties can exit. So no parties can exit, which means you're locked in. If you're locked in, now you can't say there is a risk because you've already locked in a price. And remember that forward rate was decided on the basis of the movements which will take place in the exchange rate market. And based on that, when the forward rate is decided, you've already created a lock-in. And if you've created a lock-in, you can say technically there is no risk. Correct? Of course, that risk which you're talking of is more like, something which is at the back of the mind. If, I had not entered the contract, then what? That's more like an opportunity gain or opportunity loss, but you cannot call that as a risk actually. Why do people enter into a forward contract? Because you want to eliminate, or I would say not eliminate, but I would say you want to reduce the element of risk. By entering into a forward contract at a predetermined rate, you are basically decreasing the level of risk. And of course, you can never eliminate and make it zero, but you're still trying to, reduce the risk. So in this particular case, the moment you enter into a pre-decided parameters, the risk in this particular case definitely goes down, if not eliminate. Got the point? So did you get the logic of this two particular test, friends? I'm here to get inputs on that. Did you get the logic of all this in terms of derivative, non-derivative? Don't worry, we will apply the practical illustrations as well. But first, you need to be very clear in your thoughts. Unless you know what is to be done in which situations, by looking at the questions, you can't really crack them. Okay, so that's great. I think I'm getting some inputs. Yes, we understood the concept. That's wonderful indeed. So I think let's now take it further. I'm now coming back on the chart. We'll now see the application of this as well. So when you say that the fixed for fixed test is passing, it passes. Passes means that both the factors are fixed. The consideration and the number is fixed. I would say the test passes. It becomes an equity instrument. And if you say it fails, fails means any one of the element is variable. The consideration could be variable, or the number could be variable, or the consideration number both could be variable, any one or both are variable, then it becomes a financial liability. Now let me just connect the dots before we start doing questions on this area with you. Now let's, I think, come back on the agenda. Now you've got the final version in terms of the three-step model. Now let's get some quick clarities at the start. Let's get some quick clarities before we proceed on this. So I'm just going to connect a few more dots at this stage. Now, let's, I think, first of all, give you a clarity of thought that how you are going to proceed, because this is very important, how you attack the enemy. I always tell people, questions can be enemies to you in the examination hall. And if you're conceptually clear which weapon is to be used at which stage, that gives you a clarity of thought. So I'm going to give you now the inputs before we attack the questions. You need to keep your weapons with you before you attack the questions. So I'm looking at a contract is non-derivative. I'm looking at it is derivative. I'm looking at it is non-derivative plus a derivative. Now please watch this carefully. I'm going to give you a walkthrough in terms of how the three-step model is to be applied. Now, let's first of all consider that if your mode of payment is cash, does it make a difference to me that it is non-derivative or it is derivative in nature? I am not concerned. If you say that the mode of payment is cash, now somebody asked me, so why are you not concerned if the mode of payment is cash if I have to pay cash? Can you say I'm running a risk in any case? Then what's the point? What's the point in terms of deciding in this particular case that it's derivative or non-derivative? You just need to see that is unavoidable obligations or not. So when the mode of payment is cash, don't get worried on this part. Let's not talk of this right now. If the mode of payment is cash. So when you read a question and you say, okay, the mode of payment is cash, don't get into the trouble of deciding its derivative or non-derivative nature. Here, your focus point is going to be, let me apply the three-step model. My focus will be to apply the three-step model. Can I say component-wise? I'm going to apply my three-step model. Can I say component-wise? Just get this very straight in the mind. If you see that, yes, the mode of payment is cash, you just need to apply it component-wise. Apply this on component-wise, and that would be that you will say, okay, let me look at the return. And let me see, is it mandatory or is it discretionary? And let me look at the principal money and let me see it is redeemable or irredeemable in nature. Do I stand absolutely clear on the mode of payment cash? Say yes. When your mode of payment is cash, don't get worried. Don't start looking at, is it derivative? Is it non-derivative? Don't even look at that. Just look at that you need to run your three-step model for the return that is interest and dividends and for the principal and take your call. Depending upon the terms, you decide it is FL or is it equity in nature. Correct? Okay. So this is one input. We'll talk of this later. So this part, of course, we'll talk later. Let's not talk of this. I've just made it in the chart, but I don't want to talk of this at this stage. Let's only concentrate on the pure derivative and the non-derivative in nature. Now comes the agenda when you say that the mode of payment is shares. Now comes the agenda when you say the mode of payment is shares. So here again, I'm looking at non-derivative, I'm looking at derivative, and I'm looking at non-derivative plus a derivative. This is also what we're going to see later. Let's not get into this at this stage. But I just made the columns because you can understand and connect all the permutation combinations at a later stage. Now, as I said earlier, what I've given you is the mode of payment is cash. Now, when I say that the mode of payment is supposed to be shares, when I say the mode of payment is supposed to be shares, am I now concerned? Of course, yes. So the moment you read a question and say, okay, the mode of payment is shares, let me be cautious. And I'll say, in terms of non-derivative, please apply the fixed test. Please apply the fixed test. And in terms of derivative, please apply the fixed for a fixed test in this case. Immediately you get connected and you start deciding, okay, now if it is non-derivative, I need to apply this test. If it is derivative, this test. The logic is given. Why do you do that? In this particular case, the focus is on what? The focus is on the number. And in this particular case, the focus is on what? The focus is both on the consideration and the number. The focus is on the consideration as well as the number. Now, friends, you've got a choice. And I know what the answer you're going to give me. You want to revisit on the illustrations we did in the previous class and see that if the mode of payment is shares, was a derivative or non-derivative in nature, or you want the past is a dead, let that be, and let's do some new illustrations, or you want me to do some blended mixed illustrations and have a revisit on those illustrations. Because in many of the questions which I did, the mode of payment was completely shares, and at that time, we never knew the concept of derivative, so we did not even look at the fact that it's derivative or non-derivative in nature. Your silence will be taken as that you can do so whatever you want. I'll do then to save my time and not make any revisits to the previous illustrations. Wow. Okay, so I think let's now take the journey forward then in that particular case. Okay, we get a question, sir. Logic for cash made as forward contract is settled in cash. I think, yes, I've answered that by now. That why does the mode of payment cash does not make any difference in this particular case. Okay, I think so. We can have a look at those illustrations as well. That many people said a yes on that. How I scared you in terms of the level of the standard. But friends, please feel free. If you feel that yes, I want to make a little revisit as well, ask for it. You need to ask for your things, then I give you. So tell me, you want me to make a revisit on those illustrations also quickly to have a complete picture of the three-step model, the version number 3, to see it is derivative, non-derivative, etc., etc. I think now I get the inputs from your side. So I get the answer, yes. I get the answer, yes. Let's go ahead then in that case. Okay, I'm now going to come to some illustrations with you. And let me first, I think, come at random to a few illustrations with you. This illustration 3 we'll revisit after our discussions. I've already said that we'll come back to this particular illustrations. Okay, now I think let's make a little revisit once again. So I'll just crop it up to just, give you the inputs clear. So we are on the unit number 1. This is an illustration from the unit number 1. illustration number 6 on the unit number 1 of the study mat. So let me know, friends, if this is clearly visible to you, right? Can you clearly see the document on the board? The PDF is clearly visible. Illustration 6, correct? Okay, that's great. So let me, I think, take the journey forward now. So I'm going to put some questions to you. You need to define this clearly. Silver issued irredeemable preference share. I think you know what is going in the back of your mind. It says with a face value of 10 each and a premium of 90. They carry a dividend at the rate of 8%. However, the dividend is paid only. The dividend is paid only when silver declares a dividend on equity shares. I am given the principal is irredeemable and the dividend is paid when it is paid on the equity shares. Now let's come back on the inputs first of all. Now please think the way I want you to think. Please think the way I want you to think. I'm not focusing on step 1 because I go with the input every time the issuer is going to get a contractual obligations, at least in the illustrations we're doing right now. Let me ask you quick questions now. What is the mode of payment? Look at the facts of the case and tell me what is the mode of payment in this case. Is it shares or is the mode of payment cash? And once you decide the mode of payment, then you know the next question which is going to come to you. So take a call and decide what is the mode of payment. Is he anywhere saying that I am going to make a payment in terms of share, or is it completely a mode of payment in terms of cash? You need to decide, friends. You need to take a call. Is the mode of payment shares or is the mode of payment cash? And I think I did not get any answer so far. How can you take so much time to decide? You said the mode of payment is shares. Oh my God. Where do you see the shares? It says S issued the shares and you are going to pay a dividend when you declare dividend on share. Where is he saying that I'm going to give the payment in shares? I can't see that. I have issued preference share, but to discharge the obligation, is there any payment made in shares or is the mode of payment cash? I think it is undoubtedly cash. It is undoubtedly cash. I don't see that there is anything else. So the question now is, if the mode of payment is cash, do I need to decide that it is non-derivative or derivative in nature? The answer is a big no. The answer is a big no. That means I'm back to my chart. And when I'm back to my chart, I'm just looking at return, mandatory, discretionary. I'm looking at the principal, redeemable, irredeemable. Let's see. As far as the principal is concerned, it is irredeemable. That makes it equity instrument. As far as the dividend is concerned, I am telling the preference shareholder, if I pay to the equity, I give you. Equity itself is discretionary. So if you make the dividend of the preference shareholder dependent upon the equity dividend, which is discretionary, so at the end of the day, even the preference dividend, can I say, becomes discretionary in nature? And if it is discretionary, it becomes equity instrument. If both the components are equity instrument, then the instrument is supposed to be equity instrument in nature. Simple and straight. You can just have a little quick, we didn't do this illustration last time. It says there are two main characteristics of preference share. They carry a dividend which is payable only when the company declares a dividend on shares, and they are irredeemable. Analyzing the definition of an equity instrument, it meets the definition. There is no contractual obligation to pay cash. The mode of payment is cash, but there is no unavoidable obligation to pay the cash. So it says when an equity instrument is settled, this was just a definition. Then he says in the above case, no contractual obligation arises. Since the face value is not redeemable, except in case of liquidation, and the dividend is payable only if the company declares an equity share. Since the dividend on equity share itself is discretionary, therefore the company has got an unconditional right to avoid the payment, and therefore it meets the definition of an equity instrument in this case. I don't think so that there will be any challenge because the mode of payment is cash. But let me remind you, I already said, once you go through all the illustrations, you must make your mind maps. Okay, this concept, this illustration, this concept, this illustration, and make some beautiful mind map notes to you. Let's, I think, go further. And I think, yes, I got the decision that it is supposed to be equity instrument in nature. Wow. Let's go ahead. Okay, so I think let's take another illustration with you. And this is illustration number 7. This again, unit number 1, just to make a distinction. We're again on the illustration, unit number 1, illustration number 7. So we're on the illustration number 7. Let's have a look at the illustration number 7. Now, you know how you need to proceed with the question. The first focus is the mode of payment. And if it is cash, don't get worried about derivative, non-derivative. If the mode of payment is shares, get worried and then decide the test and then make your conclusions. Let's read now carefully. It says A is investing in compulsory convertible preference share issued by the subsidiary at 1,000 rupees each. 10 is the face value and 990 is the premium. Under the terms of the instrument, each CCPS is convertible into one equity share. I am going to issue one equity share against one CCPS at the end of the 5 years. Such CCPS carries a dividend at 12% only when declared at the discretion of B. Evaluate the definition of financial instruments. Now. Let me, I think, make a statement and you can vouch me on that. Can I say the mode of payment for the dividend is cash and the mode of payment for the principal is shares? Vouch me carefully, friends. Look at the facts and vouch me carefully. I'm considering that the mode of payment for the principal is shares because you will convert each preference share into one equity share. So the mode of payment for the principal is shares and the mode of payment for the dividend is supposed to be cash. Is my thoughts correct? Is my thoughts absolutely correct? You can look at the input carefully and make a call. And that's right. So in this particular case, I can say that if you look at the return, the mode of payment is supposed to be cash because I'm going to pay the dividends in terms of cash. And if you look at the principal element, we can say the principal element, the mode of payment is supposed to be shares. And the moment the mode of payment is shares, do we need to decide it is derivative or non-derivative in nature? Yes, of course. Now, let me tell you one thing. If a company, is issuing compulsory convertible instrument, it is compulsory convertible instrument, then I would say it is a non-derivative in nature. Now, I want you to first of all apply the funda and tell me in this particular case that is this passing the fixed test or not? So because if you say the mode of payment is shares and you say it is non-derivative in nature, we are applying the fixed test. And if you're applying the fixed test, you can decide is the number fixed or not. Each share will be given one equity share. Is the number of shares to be issued, is that fixed? 1 for 1. So that means the number is not variable. It is fixed in nature. That makes it what? Equity instrument in nature. So I think now we can come back on this. So when you say that there is each preference share for the principal, this becomes an equity instrument because the fixed test passes. And when the dividends are discretionary, it also becomes equity instrument in nature. The mode of payment of the dividend is supposed to be in cash, and that is discretionary in nature. That makes it equity. So if both the elements are equity, then you can say equity plus equity. The combined instrument becomes equity in nature. Wow. Let us still read the inputs further to you. So I hope now you'll get confidence based on this. As we progress, you will start getting confidence. It says B issued the compulsory convertible preference shares. It's a conversion into fixed number of equity shares because it says one share for every one CCPS and there is a non-cumulative dividends. Applying the definition, we can say there is no contractual obligation to deliver cash. Dividends are payable only when declared, and hence there is a discretion of the issuer, and that results in equity. And the conversion is in fixed number of equity share. So both the elements being fixed equity, you can say the instrument becomes equity in nature. Trust me, you need to look at the question, attack the questions with the tools I've given you. Contractual obligation, that goes without saying a yes. Mode of payment cash, let me not bother about derivative, non-derivative. Let me just think of mandatory, discretionary, redeemable, irredeemable, and the mode of payment shares. Please decide derivative, non-derivative, and then apply the fixed test or fixed for fixed test, and then decide. Let's look at another question. Let's see the illustration 8. It says Target Limited took a borrowing for 10 lakhs. Z enters into an arrangement for settlement of the loan against certain number of equity shares, whose value will equal 10 lakh rupees. And for this purpose, the fair value per share to determine. It says the fair value of the shares to determine. Let me just cut this out. So it says in this particular case, the fair value of the shares to decide the number of equity shares to be issued is based on the market price of the shares at a future date upon the settlement of the contract. What is the mode of payment? I'll just put across that question. What is the mode of payment in this case? We are very clearly given that Target took this loan and he says, I'll give you number of shares, and to decide the number of shares, I will consider the price on the settlement date. So what is the mode of payment in this case? I guess undoubtedly it is shares. So let me ask you the obvious question. Am I supposed to decide that it is derivative or non-derivative in nature? Tell me. If your mode of payment is shares, do we need to decide it is derivative or non-derivative in nature? And that's right, yes. Now let me ask you the obvious question. In this case, the loan is already, taken. You've already received the consideration, and you can even decide on that basis. If the consideration is already collected, what do you think is going to be ND, non-derivative, or derivative in nature? You've taken the loan, and now you're just telling the person that the number of shares to be issued against the consideration already received is going to be paid at a future date. So what do you say? Is that supposed to be ND, non-derivative, or derivative? And I think I get the answer quickly on that that's non-derivative in nature. That's wonderful indeed. So it is undoubtedly non-derivative in nature. Super. So I think let me just come back on the agenda. So in this particular case, it says that for this purpose, the fair value is at a future date. So I can say that the mode of payment in this case is shares. And having said that it is shares, it is non-derivative. So we said we will apply a fixed test in this particular case. And you can see, is the number of shares fixed or not? Decide. I will give the number of shares by dividing it by the fair value on the date of conversion, on the date of settlement. So which means your number of shares will land up variable in nature. And if it turns a variable, it is undoubtedly a financial liability because we are going to issue variable shares, and that makes it financial liability. We'll still have a quick read on that part. In the above scenario, Target has got an obligation to issue variable shares whose value will equal 10 lakhs. Hence, the equity shares are used as a currency note for the purpose of settlement. Since this is variable number to be issued on a non-derivative contract, it says for a fixed amount, it tantamount to equity shares as currency, and this meets the definition of financial liability. When you're going to present your answer, you can very carefully give your thought process And sometimes people ask me, so should I answer the question using the three-step model? Why not? At the end of the day, you may not call it a step 1, 2, 3, or you can just call it as evaluation criteria 1, 2, 3 points, and start telling the examiner the thought process with which the evaluation is occurring. And trust me, if your conceptual clarity is visible to the examiner, he'll give you marks on that. So what's the problem if I present it on step 1, 2, 3? There's no problem. Are you getting the confidence now? Are you able to connect the dots in terms of the version 3? So we need some more examples on the derivative as well. Don't worry, we'll get that. But are you not getting confidence at this stage? Are you getting now the feeling that, yes, I'm able to look at a question in a very systematic manner and make my decisions in terms of the criteria? Lovely. That's great indeed. Superb to hear that. Yes. Okay, so let's, I think, take it further. Let me now take this further. Let's have a look at a few more questions now. Okay, so we are going to another question. This is again on the, now this is unit number 3. I'm now coming to the unit number 3. This is a question which we did in the previous session as well. But I'm just revisiting that illustration just to keep you connected. Is it derivative or is it non-derivative in nature? So we're coming back on the illustration 1, unit 3. Now this is unit number 3, illustration 1. It says A issuer issues the preference shares to B the holder, and the preference shares are redeemable at the end of 10 years from the date of issue and entitles the holder to a cumulative dividend of 15%. Then it says the rate of dividend is commensurate. That part is yet to be explained. That's pending illustration 3, which will be our next focus of discussions after this version 3 is done. Now, please decide the mode of payment in this case. Give me your results on the mode of payment. Carefully decide the mode of payment. What is the mode of payment? Is it cash or is it shares in nature? So we are saying that it's redeemable and there is a cumulative dividend. So what is the mode of payment? Is it cash or is it shares? And I think I get the answer on that. The mode of payment is what? Let's see the results. That's absolutely correct. The mode of payment is undoubtedly cash. So can I say, do we need to decide it is derivative or non-derivative in nature? No. Because if the mode of payment is cash, I don't need to decide that. So in this particular case, we can say the mode of payment in this case is cash. I don't need to decide it is non-derivative or derivative in nature, not required to take a decision. So the only thing to be seen is mandatory, discretionary, redeemable, irredeemable. That's it. So let's look at. So when it says it is redeemable, it is financial liability. When you say it is a cumulative dividend, it is financial liability. Both the elements are financial liability. So the instrument on an overall basis becomes a financial liability in this case. Let's read. It is a mandatory fixed dividends and the redemption by the issuer is for a fixed amount at a future date. There is a contractual obligation to deliver cash, both in terms of dividends and principal, and it cannot be avoided. And if it cannot be avoided, it is supposed to be a financial liability in its entirety. Both the components are FL, and therefore it becomes a financial liability. Wow. Let's go further. So we had some good questions on this area as well. We did this illustration 2. 4, I'm not revisiting. I think I've already given you the inputs. So I'm just coming to illustration 2 and 3, unit number 3. Unit number 3. So let's have a look now at the illustration number 2 first, then we go to the illustration number 3. X issuer issues debentures to Y and they are redeemable at the end of 10 years. Interest is payable at the discretion of the issuer. And then the same sentence is given. We need to decide the nature. Now quickly decide. What is the mode of payment? Is the mode of payment cash or is the mode of payment shares? Am I anywhere given in the question that I'm going to pay the principal or dividend in terms of share? I don't think so. So the mode of payment rightly said is cash. If the mode of payment is cash, we know we don't need to decide that it is derivative or non-derivative in nature. That decision is not required to be taken. We just need to see mandatory, discretionary, etc. So when it says it is redeemable financial liability, when it says it is at the discretion, it is equity instrument. And if you consider the financial liability equity instrument put together, it becomes a compound financial instrument in this case. And you can see very clearly that this is going to be discussed later, but it is undoubtedly a compound financial instrument because one of the components is FL, the other component is supposed to be equity. So the things are going to be very easy. A mode of payment is the deciding factor. So let me reiterate, what I said in the previous session as well. The name of the instrument is never important. It is the mode of payment which is the deciding factor. And the mode of payment decides the kind of test to be conducted. Because if the mode of payment is cash, then you are not conducting any kind of test. You're only looking at the concept, is it unavoidable? But looking at the terminology, mandatory, discretionary, redeemable, irredeemable. But when the mode of payment becomes shares, then you need to see that, okay, is it derivative, non-derivative? Then you decide the test. That is the fixed test to be applied, or is a fixed for a fixed test to be applied, and then take your calls. Let's have a look at the illustration 3, and it's time now to get into the illustration 3 of the unit number 1 as well. After this, I'm going to go back to the illustration number 3 of unit 1 as well. It says company P takes a loan, and the loan is perpetual and entitles the holder to fixed interest of 8%. Let me quickly ask you, what is the mode of payment in this case? Let's put the questions quick. What is the mode of payment? Is it shares or is it cash? I don't see that there is any mode of payment in terms of shares. I guess the mode of payment is completely in terms of cash. That's right. So if the mode of payment is cash, then I don't need to see that is it derivative or non-derivative in nature. That segregation technically not required. And I think if you go with the fact that this is perpetual, that means it is equity. And if this is fixed interest, it becomes a financial liability. So technically on the very apparent level, you can say that equity plus financial liability put together, it becomes a compound financial instrument as of now. But we'll talk of this a little more detail later. Before we proceed further, friends, I need your comfort zones now. I need you to give me that what is your comfort zone on a scale of 10. I want you to judge yourself. Tell me what is your comfort zone on a scale of 10. If you were to decide the application of the version 3 as of now, though I know we have not seen any instruments which are practically derivative in nature, we've been more or less looking at cases where they are non-derivative in nature. 9 out of 10, that's wonderful indeed. I know many of you will be now waiting, so I think we'll come to that illustration 3 unit 1 later. Let's go ahead. Okay, so now this makes it interesting. Now I think let's give you something interesting at this stage. Now this can be a very interesting illustration to watch. Illustration number 5. Now watch this very carefully. Watch this very carefully. So we've got 13, 14 also, which we had seen earlier. And yes, we'll look at the 15th one as well. So I think let's first do one thing. Let's go to the 15th illustration. I think that would be more appropriate in nature. Let's give you a little technical illustration at this stage. So we just quickly revisit on the illustration 13, 14 also. Let me just crop this up. So I'll just come back on the agenda. I think let's go 13, 14, 15 and then come back on the previous one. So we're looking at illustration number 13 and 14. So this also we saw last time. We just tried to revisit on the 13, 14. This is the very first illustrations I did with you in the previous class. But I wanted to revisit, so that you get the comfort zone of applying the version 3 in all the cases. CBA issues convertible debentures for a subscription of 100 crores. The debentures are convertible. They are convertible. What does this mean? That is it optionally convertible or is it mandatorily convertible? Because that would decide the fate, whether it is derivative or non-derivative, if the mode of payment is shares. So when you say they are convertible, are we saying it is mandatorily convertible? Yes. So when you say that they are convertible, it means it is supposed to be a mandatory conversion. And let's now proceed further. Then he says that using a predetermined formula, it's a predetermined formula, not a number. So you can see 100 crores compounded with an interest of 10% for 5 years, and we divided with a fair value on the date of conversion. Now, let me ask you, what is the mode of payment? What is the mode of payment in this case? Undoubtedly, I think you can decide what is the mode of payment in this case. Is it cash or is it shares? And I think I'm getting the answers quick and fast on that. Yes, it is undoubtedly going to be the mode of payment shares. I think it's very clearly stated out here that the mode of payment is supposed to be not cash. I think somebody said cash. No, it's not cash. You are giving shares. They're convertible into equity shares. The mode of payment is shares. And if it is shares, do we need to decide it is derivative, non-derivative? Yes. I think if you remember an illustration which I just did back in unit number 1, I said if it was compulsorily convertible, that is mandatorily convertible. A compulsorily convertible would mean that it is non-derivative in nature. And if it is non-derivative in nature, you need to apply which test? We're going to apply the fixed test. And just look at the number. Because you've already received the consideration as well. It is only the number which is going to be issued at a later date. Now you can see we are dividing it by the fair value, which is on the date of conversion. So is that variable or is that fixed in number? This is variable in number. And if it is variable in number, it becomes a financial liability. Last class, when we visited on this particular illustration, we never took a call that it is derivative or non-derivative in nature. But today, I think the idea of revisiting this illustration is to tell you that since the mode of payment is shares, it becomes a case that, it is non-derivative because it is mandatorily convertible in nature. Okay. Let's, I think, just have a quick look now on illustration 14. The company issues convertible debentures. What people get a sense when they read convertible? Oh, convertible means it's derivative. No, you can't do like that. You can't say that if there is a conversion, it is derivative. It all depends whether there is an option to convert. And trust me, my next focus is going to be looking at an instrument which is optionally convertible. When you give the holder an option to convert, the concept of option means derivative. We'll see that in the next one. So it says D issues convertible debentures of 100 crores and they are convertible. When you say they are convertible, that again indicates that there is a mandatory conversion. When it says it is are convertible, that means it is mandatorily convertible. And then it says it is going to be converted into 15 crore shares of 10 each. I think goes without saying that this analysis is equally applicable to illustration 15. The mode of payment is shares and it is mandatorily convertible. It's non-derivative and therefore you apply the fixed test and the number of shares to be given is already pre-decided. It is fixed and therefore it becomes an equity instrument in nature. Wow. Okay, so this is done. And that was the answer on, though I don't need this, so maybe I can just, skip this particular part. So I'll just delete that part. Now let's, come to another illustration. Now we're coming to the illustration number 15. Now we're looking at the illustration number 15, but that's an interesting one. That's an interesting one. Maybe first we can see 13 and then 15. because you need to get some inputs. No, illustration number 5. Yes, I think we can have a look at the illustration 5. Okay, I think before that, let me just maybe add my own example to you. I don't know if you know what is a share warrant. Before I take you to the illustration, I don't know if you know what a share warrant is. Do I need to explain you what a share warrant is? Yes, sir. Just give us in a few liners that what exactly is a share warrant. So I'll tell you what a share warrant is, and then we can decide some inputs on this and then come back on the illustration. Companies issue share warrants to their existing equity shareholder, and you tell them that I am giving you these share warrants, which gives you an option to buy the shares at a future date. Mind the words. You tell the existing equity shareholders that you get the option to buy the equity shares at a future date. And if they want, they may. If they don't want, they may not buy the shares. The share warrant only entitles the existing equity shareholders of the company, to decide that they want to buy the shares at a future date, so they get an option to buy. Now, a very quick question to you. Do you think a share warrant is supposed to be a derivative or not? Tell me. Make your evaluations and tell me, do you think a share warrant is supposed to be a derivative or is it non-derivative in nature? Apply the 3 parameters which I gave you in terms of deciding that whether it is derivative or non-derivative, and see that are those 3 parameters getting fulfilled or not. Okay, let's I will make a walkthrough with you, and let's see that does it meet the definition in terms of a derivative or not. And I think I got the inputs. Yes, it is a derivative. You're correct. Let me, I think, put the 3 questions to myself. Is the share warrant deriving its value? Is the share warrant deriving its value from, is it deriving its value from the value of equity shares of a company? Say yes or no. Is the share warrant deriving its value from the value of equity shares of the company? Yes, of course. Because at the end of the day, if you say that I will buy the shares or not, you're going to look at the value of the equity shares and take a call that whether you want to buy equity shares at a future date or not. Is there going to be a future settlement? Is there going to be a future settlement in this particular case? Undoubtedly, yes. The share option, the share warrants gives the holder an option to exercise the shares at a future date. So you're definitely giving them an option, and that is an option to be exercised at a future date. So I would say yes, this is a yes, this is a yes. And is there any kind of initial investment? Is the initial investment made? Is it zero in this particular example? I would say definitely yes. Because when the shareholder would have taken the warrants from the company, he would not have paid any amount. So that means there was no initial investment, and the settlement is at a future date, and the value of this is getting derived from the value of equity share. I would say it fulfills all the features, and we can definitely say that yes, it is a derivative in nature. We can definitely say yes, it is a derivative in nature, and it's a pure derivative. I'm not saying it's a non-derivative, it's a pure derivative in this case. And if it is a derivative in nature, and let's say I tell the shareholder that I will give you 1 equity share. I tell them that against 1 share warrant, I'll give you, let's say I'm going to give you against 1 share warrant 2 equity share. So I tell them that I am going to give you 2 equity shares against 1 share warrant. That is one thing which I tell them. And I say that I'm going to give you the shares at a price of 25 per share. So I say that against every 1 share warrant, you're going to get 2 equity shares at the rate of 25. Is the consideration the company going to get in the future fixed? Yes, 25 per share. And is the number of shares to be issued against that warrant, is that fixed? That is 2? Yes. So can you see in this particular case, if I would apply a fixed test because it is derivative in nature, the mode of payment undoubtedly is shares. The mode of payment undoubtedly is shares in this particular case. And I am telling the shareholder that I'll give you 2 shares against 1. It's fixed. It is predetermined in number. And you need to pay me 25 per share. So we can say the consideration is fixed. Yes. Is the number also fixed? Yes. And if this passes, it becomes an equity instrument in this case. That was a case where we can say it is a pure derivative instrument. So I think we've got a feel of looking at a lot of non-derivative contracts, look at a feel in terms of a derivative, but we need to also now look at questions where there might be a mix of a derivative and a non-derivative put together. Let's, I think, first go further. And let's have a look at the illustration number 15 now in this case. Let me read the illustration 15. It says, ST purchases an option from AT, entitling the holder to subscribe for a fixed number of equity shares at a fixed exercise price of 50 per shares. At any time during a period of 3 months, the holder paid an initial premium of 2 rupees an option, whether it is classified as an equity or not. Now, let me first ask you something very simple and straight. In this case, it says ST purchases an option from AT. And in this particular case, we can say AT is supposed to be what? The issuer. And ST purchases means he is the holder. So let's get one thing very correct at this stage. One says ST purchases from the company AT. AT was the issuer and ST is the holder. Now, you are deciding things from whose point of view? Are you deciding things from the point of view of AT or ST? I think let's get that straight first. We are on Index 32, and when we are on Index 32, in this particular case, a classification is going to work from the issuer perspective, correct? And if I'm looking at the issuer perspective, I'm looking at things from the AT's point of view, not from the ST's point of view. Now, I did not give you much inputs, but I think you might have some knowledge when ST purchases an option, and in this particular case, he paid a premium. He paid a premium, so he gets what is called a long position, where he gets the right to decide, and the other party is going to get what is called a short position. I know I've not explained you those things. I'm just taking a little inputs from your financial management area. Maybe if you feel, I can give you the inputs on the calls and puts after that. But in this particular case, if somebody pays a premium, he gets a right, and the other person getting the premium is under an obligation. So from the ST point of view, we can say that he is getting a premium. So from the AT's point of view, he's getting a premium, and therefore it says written option. Written option means that you are basically taken a short position, where you take a premium for the holder and you've now got an obligation. That puts you under obligation. The other person says, yes, I want it. I say, okay. The other person says, no, I don't want it. I say, okay. That puts me in a short position. Now, let's see further. So in this particular case, first of all, tell me, is it a derivative or not? When you have entered into an option agreement where the issuer tells the holder, you pay me a premium and you get the right to decide at a future date. You want to buy shares? In that particular case, I am going to give you a fixed number of shares at a fixed price of 50. Is this supposed to be a derivative? An option contract undoubtedly is a derivative contract. So when you say that it is a derivative contract, and I think you can decide the parameters as well. In this particular case, when you can say that the holder is going to buy the shares, is the value of this contract derived from the value of the equity shares? Yes. Is the settlement going to be done at a future date? Yes. Is the initial investment zero? Not zero, but is it negligible? Yes, it's negligible because you're paying a premium of 2 rupees against a contract price of 50, which seems to be quite negligible in nature. So we can say all the three characteristics of a derivative will get met. And the mode of payment in this case is shares. Because the mode of payment in this case is shares, we decided actually that it is derivative. It's the other way around. Though I said derivative, but when you say the mode of payment is shares, you got to decide that yes, it is derivative in nature. And if it is derivative in nature, you need to apply the fixed for a fixed test. Now you can tell me, is the fixed for a fixed test getting passed or not? You take a call and decide, is the fixed for fixed test getting passed? You will give a fixed number at a fixed exercise price. Is the consideration to be received in the future fixed? 50. Is the number of shares to be issued fixed? It says we're going to give a fixed number of shares. So is the consideration both fixed in number? So what do you say? Yes, the fixed for fixed test will pass in this particular case, and it becomes an equity instrument. And that's right, we got the correct answers on that. Undoubtedly, it becomes a case of an equity instrument in this case. Wonderful indeed. So we can say that the fixed for fixed test will pass. This is also fixed, and this is also fixed. So we can say it is undoubtedly an equity instrument. So I think I'll just quickly read the inputs. For the issuer 80, this option is an equity instrument as it will be settled by exchange of fixed amount of cash for a fixed number. Amount is the consideration. So you're going to get a fixed consideration and that you're going to issue fixed shares. Then he says, just for the explanation point of view, if on the other hand, if the exercise price of the option was variable, say it is benchmarked to an index or variable. So let's say, for example, I tell him that, okay, the consideration which you're going to pay me is not 50, but it depends upon a benchmark rate. So if the benchmark rate changes, the exercise price changes. So the consideration becomes variable and it will be a financial liability. In that case, it becomes a financial liability in the books of issuer, that is 80. Wonderful. Now, I know what you're thinking. You're thinking, sir, we've taken illustrations which are based on non-derivatives. We've taken illustrations which are based on derivative. So what about illustrations which have got a derivative and a non-derivative blended together? Yes, that's what my next focus is. But before the next focus, that illustration 3 is also pending. I think let's keep that illustration 3 pending for some time before we come to the discussions on compound financial instruments. So I'm just reminding you again and again, so that at least I forget, you could remind me back. So illustration number 3, unit number 1, unit number 3, which is same, is pending. So we'll revisit on that illustration 3 of the unit 1 and 3 once I do the concept of compound financial instruments, because I need to give you some more clarity on a perpetual debt. But now the focus right now is, we've seen instruments which are derivative. We've seen instruments which are non-derivative. Now we need to see instruments which are blend of derivative and a non-derivative. So I think we'll, prior to this, take a break. And I think then after that, we can, I think, come back to this, illustration 5 with you, because that's going to make it a little bit heavy. So I think we'll definitely raise the level as compared to the previous session. But it's getting interesting. I think so. I hope you also think on the same lines. Okay, so let's do one thing, friends. So do we require both way? Do we require both way in the sense, I didn't get that? Both ways for what?
Sir, illustration number 15, where the answer has been given in both options.
Okay. No. Right now, just for explanation point of view, they've said, that if the consideration was variable, it becomes an FL. In the exam, you just need to make a mention that it's equity. That was just for explanation, understanding perspective.
Okay, thank you.
You're welcome. Right, friends. So I think it's time to give you some break, 10, 12 minutes, and I join you back after the break, and then we start discussing the blended instruments. Enjoy your break. Thank you. Mind, and I think now it's time to take you to the next level of our discussion, because so far we have just made discussions on that if it is derivative, then what is the test to be applied? That is what we call the fixed for a fixed test. And if it is supposed to be non-derivative, then you apply the concept of fixed test. Now I think it's time to look into a contract, or you can say an instrument, whatever, where you've got a blend of a derivative as well as a non-derivative put together. Now this is going to be technical. So the next, around 10-15 minutes is going to be a little heavy for you. But just see this carefully, analyze this carefully. So before I revisit, before I look at the illustration number 5, I think I need to first of all give you some inputs at this stage. So let me, I think, first of all, come back on the agenda. And where I said an instrument is a non-derivative as well as a derivative. Now, the first question what comes to the mind is that what are the kind of examples of instruments which are both containing a non-derivative and a derivative? Now, I'm just making a statement, and very carefully, generally. I'm saying generally. So let me put the words very carefully, that generally, when you see that there are optionally convertible instruments, when you issue optionally convertible instruments, optionally convertible instruments will generally be, you can say, a good examples of instruments which contain both a derivative as well as a non-derivative. And the reason is, I'll tell you why. Let's say, for example, if you look at a debenture. So let's say, for example, a company issued a debenture. Now, if I say it's a debenture with no ifs and buts, I would say it is per se a non-derivative contract. If a company issues a debenture and I don't give you any kind of features attached, then I would say it is basically a non-derivative instrument, which is, let's say, redeemable in the next 5 years. I'm going to pay interest on that for the next 5 years. And I'm going to pay the principal at the end of 5 years. It's a pure non-derivative instrument. But the moment I add the element that I'm giving the holder, for example, the option to convert, the moment I add the option to convert, so this element leads to what you can say is a derivative. So I'm using my words very carefully. So I'm saying when you look at the language of the question, it says the company issued an optionally convertible preference share. You know what we call it as OCPS, optionally convertible preference shares, or we've got OCD, that is optionally convertible debenture. In fact, let me tell you, that in a practical world, you're not going to see situations where there will be, plain vanilla kind of instruments. You'll always land up seeing that there will always be, instruments which have got some derivative elements in there. And I think if you want to see those instruments in a practical world, you'll see, if you've done your audits, you might have gone through your clients, and you guys have seen, they issue what is called OCPS, optionally convertible preference share, OCCPS, optionally convertible cumulative preference shares, OCD, optionally convertible debenture. Now, the moment you see that there is an option to convert, that option to convert is basically the choice. And the choice is the option that is the derivative. So you can say in those particular cases, you can easily reach a conclusion that this instrument contains both a non-derivative as well as a derivative element. And that's what we said is called, you can say technically, a case of embedded derivative, that the derivative is, inserted or embedded within the instrument. And if these kind of instruments becomes compound, for example, then we also call them as hybrid instruments. So for example, when you land up saying that this non-derivative element is, let's say, a compound financial instrument, then you would say that, if you put this together, it becomes something what we call an hybrid financial instrument as well. So let me just connect the dots once again before we go further. So you need to keep in mind that when you read the language of the question, what kind of language is going to give you the initial start that this could be an instrument with a derivative as well as a non-derivative put together. So generally, as I said, if you see that there is any kind of option which is given to the holder, so it could be an optionally convertible debenture, it could be optionally convertible preference shares, that is going to give rise to the derivative element embedded in the instrument. Now, one thing which you already know, let's consider the mode of payment is shares. Now, to the non-derivative element, you need to apply a fixed test. I'm saying if the mode of payment is shares, then to the non-derivative element, you need to apply the fixed test. And to the derivative element, you need to apply that is a fix for a fixed test, which means the non-derivative element could be equity or FL, and even the derivative element could be equity or FL. So get this very clear. So what is the main agenda is that you need to apply two different tests. To the non-derivative element of the contract, you need to apply a fixed test. And to the derivative element, you need to apply the fix for a fixed test. And the possibility is that the non-derivative either becomes equity or FL, and the derivative also becomes equity and FL. Now, I'm just going to give you a data. I'm not going to give you the logic for that. That will get developed when we come to 109, Index 109. If, for example, let's say, for example, if you say that this is a compound financial instrument, like the assumption is this is a compound financial instrument, and your option, the derivative, becomes equity. I will not segregate the equity. I will not segregate the equity, that is the derivative element, out of the contract. I'll let it be. I'll not segregate the derivative element out of the contract. Now, if you ask me why at this stage, it's very difficult to explain. But the standard says that if your derivative element has got an equity, you say that it is passing the fix for a fixed test. I will not segregate the derivative. I'll say let the derivative be there. Let's not segregate the derivative included in that instrument. But if that derivative is supposed to be a financial liability, then I will definitely segregate. So can you come again? Can you come again on that input? Let me, I think, show you that in writing. So the first thing which is coming to the mind is, what I'm giving you is, let's say you come to the input that there is an optionally convertible. There is an optionally convertible financial instrument. So we will reach an input immediately that, okay, this has got a non-derivative and this has got a derivative element. So see the attacking strategy. Before I take you to the illustration 5, we're just getting the attacking strategy clear. So when you say that it is optionally convertible financial instruments, I would say that yes, it has got a non-derivative and the option is a derivative. Now, if I go with the fact that the mode of payment in this case is shares, I'm going with the fact that the mode of payment is shares, not the mode of payment cash. Because if it is supposed to be cash, then the distinction goes off. So if the mode of payment is shares, then we know that the test to be applied in this case, here we need to apply the fixed test. And here we need to apply the fixed for a fixed test. Here we need to apply a fixed for a fixed test. So we need to first appreciate that two different tests will be evaluated. Now, when you apply the fixed test, you may reach the conclusion that number is fixed and therefore it is equity instrument. You may reach the conclusion that the number is variable and therefore it becomes a financial liability. So you will apply the fixed test to reach a conclusion at that level. Next, when you say fixed for a fixed test, then if you say yes, it passes, then we will say it is equity instrument. And if you say it fails, then we will say it is supposed to be financial liability. So you will apply independently. The two tests to the two components. You will apply the two tests to the two components. This time, the two components are not return and principal. This time, the two components is the non-derivative component and the derivative component. So you will say, okay, let me apply to the non-derivative component a different test, and let's me apply the derivative component a different test. Now, what I'm coming to the input further, now watch this carefully. The standard says, let's say, for example, I'm now going with the input. The standard says you decided the non-derivative is, let's say, CFI. I'm going now with the next presumption. The first was that the mode of payment is shares. Now I'm going that let's say you decided the non-derivative. You decided the non-derivative is a compound financial instrument, and you decided, so in which case you will segregate both the financial liability and equity. How do you do that? We yet to see. But let's say by applying the three-step model, you reach the input that this CFI, and it has got a financial liability and an equity instrument component. And when you applied a derivative, you decided it is either FL or you decided it is equity instrument. I'm just giving you some new data. If the non-derivative is decided to be a CFI, if the non-derivative is decided to be a CFI and you've decided the derivative to be FL or equity, now what the standard says? The standard says that if you decide the derivative is equity, in this case I'm talking, if you say that the derivative is equity, there is no need to segregate this derivative. Let the derivative be embedded. Don't take it out. Don't take it out. And there is a logic, which I'm not explaining right now, because we'll understand that once we understand the split accounting for CFI. So let's not get into the logic. Right now, just accept the fact. So we are saying that if this derivative becomes an equity instrument, I will not segregate the derivative. Let it be. Let it be. Don't segregate. So just calculate these two elements and don't segregate equity. But if it becomes a financial liability, I will definitely segregate the derivative. So let me just connect the quick dots. As you can see, what is written. So I'm going with the presumption that if the mode of payment is shares, you need to apply to an optionally convertible instrument a separate test for the non-derivative component, a separate test for a derivative component. So my first input which I've given you is that if you've got a, let's say, optionally convertible instrument, you read the question, optionally convertible instrument, I'll say, okay, so there are two components. There is a non-derivative component and there is a derivative component. Now, as far as a non-derivative component is concerned, apply a different test. And as far as the derivative is concerned, apply a different test. Okay, one input digested. Then I said, let's say for example, when you decided the non-derivative instrument, let's say it became a CFI. Let's assume that it became a CFI. So we yet to learn how will you segregate the FL equity. We'll learn that technique. But if it is non-derivative CFI, I'll say, let me segregate the FL and equity. This is a non-derivative FL and this is a non-derivative equity. Now, the derivative is also decided to be FL or equity. Now, what does the standard say? That if your derivative is equity, there is no need to segregate the derivative. Let the instrument be split in two parts only. Let the instrument be split in two parts only. These two parts only. Don't segregate the equity derivative. Why? We'll see later. Why? We'll see later. But if the derivative is a financial liability, I'll segregate three elements. I'll segregate the financial liability, non-derivative element, equity, and I'll segregate the financial liability. In that case, my compound financial instruments will get three elements. Out of the non-derivative, you are going to get the non-derivative FL and equity. And the derivative element is going to be called as a derivative financial liability because the accounting of a derivative financial liability is different. The accounting for a non-derivative financial liability is different. So now this is getting too technical for me. I am thinking, sir, example, but I'm getting a little now tricky in the situation. Don't worry. I've just given you some data. You just need to digest that and we'll further coordinate all the dots across. But did you get my basic thought process clear? Tell me. Did you get my basic thought process clear that what am I explaining in terms of a non-derivative and a derivative? Then I take the journey forward on this. So can we see an illustration of this type? Of course, I'm going to take you to the illustration. But before, we'll look at the illustration, we need to get some insights in terms of things. So no worry, let's now do one thing. I'm now going to take you back on the illustration number 5. So let's have a look at this very carefully. It says optionally convertible preference shares. Optionally. Let's ask you quick questions now. As you read the heading optionally convertible preference share OCPS, do you think it would be non-derivative? Do you think it'll be derivative, or is it going to be ND plus D, non-derivative plus derivative put together? Tell me. I think you'll easily decide on this agenda that this is going to be both in nature, because when I say there is an option, you can say it is undoubtedly going to be derivative and non-derivative put together. Wonderful indeed. Now let's read further. D issues the preference shares to G. The holder has got an option to convert the preference shares to equity instruments at any time up to a period of 10 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of 10 years. We need to examine the nature of the financial instrument. Okay, now see what it says. The instrument has got two components: the contractual obligation that is conditional on the holder exercising the right to redeem, and the conversion option with the holder. The first component is a financial liability because the entity does not have the unconditional right to avoid cash. Well, this illustration is going to be revisited again. I'm going to revisit the illustration again, but this is illustration 5. I am going to take you to the extended version of this illustration. The illustration is not complete. In the unit number 3, this illustration is being revisited again. So I'm going to take you back on this illustration, that is illustration number 5. Illustration number 27. Illustration number 27 in terms of unit number 3. This was illustration 5, and it's continued from the illustration 5, that is illustration 27. That is illustration number 27. So I'm revisiting the same illustration with a little more deeper angle. So we're looking at illustration 5 only, but it's 27, 5th illustration once again with a deeper insight. Let's come back. So it's the same case. D issues preference shares to G. The holder has got an option to convert to equity instruments at any time after 10 years. If it is not exercised, then you can redeem at the end of 10 years. Examine the nature of the financial instrument. Now, as I read, don't get worried. I'll explain in detail. I'm just reading. This part is saying what was given in illustration 5. That was regarding the first component. Then he says the other component, that is the conversion option. Is he talking of the derivative? Yes. So when he says the first component, is he talking of the non-derivative? Yes. It says the first component is a financial liability. The other component is, it says it is an equity feature. If I am not given any data in the question, I am not given any data in the question to decide that the fixed for fixed test is passing or failing. I am only given that there is an option to convert, but at what terms? Is he going to get fixed number of shares for a fixed consideration? I don't know. I don't have a data in the question. So on the assumption, the solution says that it is going to be equity if the fixed for a fixed test is satisfied. I don't know if it is going to get satisfied. If the conversion option does not fulfill the test, say because the conversion ratio varies in response to an underlying variable, it will be a derivative liability. And such an instrument is called an hybrid instrument. Such an instrument is called an hybrid instrument. So we have understood a bit, but I think we need more clarity. So what I'm going to do, I'm now going to do some story time to you. I'm going to give you some story time and then I'm going to come back on this illustration. So it's going to take me almost like 20 minutes or so. The next 20 minutes are going to be crucial. Either you get this or you don't get this. The chances are probable you'll get this, but T and C apply. If you're going to hear each and every word carefully, the next 20 minutes, you will get this illustration 100% clear in your mind. And I'm going to take very simple examples to make you walk through on the understanding. Nobody will revisit this. Let's come back. Now, please hear me carefully. Let's do some story time to you to get this understanding clear. So let me give you a little story time and please hear this carefully. Let's talk about three people. We're going to talk about three people. So let's visualize. Let's say this is Mr. A. Let's say this is Mr. B. And let's say this is Mr. C. So I think I should give them some different expressions in life as well to understand the picture. So let's say he is the smiling man, and let's say we're looking at another man which has got no expressions in life, and let's say another man who's got a little sad face out here. Wow. So friends, what I'm going to do in the next couple of minutes, I'm going to give you a story, and you need to understand the story and give me some answers on that story. Let's begin the story. There is a company XYZ Limited, and this is Mr. A, and let's say this is Mr. B, and let's say this is Mr. C. So let's say we've got XYZ Limited, and this is the company which is going to issue the instrument. So this is the issuer, and ABC, of course, are the holder. So Mr. ABC are the holder and the company XYZ is the issuer. Now I'm going to give you a storyline. You need to hear the story and give me some inputs based on the story. Number one, the story of Mr. A. Mr. A goes to the company XYZ and says, I want to invest into your company. The company puts him a question. Are you willing to take a risk? Mr. A categorically says no. He categorically tells the company that if you want me to take a risk, Mr. A says, I will not take any risk. I want you to give me interest at market terms. And I want you to repay my principal at the end of 5 years. He says, I am not willing to take any kind of risk. You need to pay the interest at market terms for the next 5 years and then repay my principal money at the end of the 5th year. Tell me, what kind of instrument will company XYZ issue to Mr. A? Considering that he is not willing to take risk, he tells that you pay me interest on market terms, you pay my principal money back. What kind of instrument do you think Mr. A will get from the company? Let's look at your inputs and see what I'm getting. So I am getting the first input, financial liability, and beautiful drawing with the financial liability. That's wonderful indeed. Super. I think we got the correct answers that it is a financial liability. So you understood the concept very well. That in this case, the risk is not being taken by the holder, but the risk is taken by the issuer. And if the risk is taken by the issuer, we can say the company is going to issue a financial liability to him. Super. Let's go to the next storyline, Mr. B. Mr. B also goes to the company and tells the company XYZ, I'm also willing to invest money into your company. The company puts him the same question and says that, are you willing to take a risk? And Mr. B says, yes, I am willing to take any level of risk. So the company says, we'll make the company grow. And we will ensure that if you sell your instruments, you can sell it at a good price in the market. But don't come back to us. Don't come back to us and ask us that can we give you some returns or not. We don't promise any returns, but with this money, we're going to run the business in all prudence. And we'll let the instrument prices soar up and you can always convert your things, your wealth into cash. So he says, I'm willing to take a risk. If he's willing to take a risk, what kind of instrument will company XYZ issue him? Take your call. Unlike Mr. A, he is willing to take that kind of risk. So what kind of instruments will the company issue to Mr. B, considering he wants to take any level of risk in this case? So I think I get the inputs in this case that it is going to be equity instrument, and I think rightly given. So somebody said a compound financial instruments. Why compound financial instruments? He is willing to take a complete level of risk. So I think in this case, it should be an equity instrument. Agreed. Now let's come to Mr. C. Mr. C also goes to the company XYZ, tells that I am willing to invest the 10 lakh rupees into the company, and the company puts the same question to him. Are you willing to take a risk? He says, I'm not like Mr. A, who's risk averse. I'm not like Mr. B, who is a risk lover. And in between the two, I will take some calculated risk. I'm neither like A, I'm neither like B. So the company tells him, sir, we've got a good offer for you. They say that to Mr. A, we pay interest at the rate of 12%. They say, we will give you, sir, interest at the rate of 10%. The company says, so we'll give you interest, which is at the rate of 10%. Now, Mr. C says, why? You give him 12% interest, and to me, you give me a 10% interest. We say, so we'll give you an option to convert. After a period of 5 years, you want cash, we'll give you cash. You want shares, we'll give you shares. You decide, and we give it to you. He doesn't get the option. He's going to get cash only. So therefore, he gets a better interest at 12%. If you're willing to compromise on the 2% interest, if you're willing to compromise on the 2% interest, we will give you the option to convert. If you feel after 5 years you want shares, take shares. If you want cash, you take cash. You decide, and we'll deliver it to you. So there is no free lunch in life. So if you want the better position, that you want shares or cash, let's compromise. You take a 2% less interest. So is the company being able to pass on some risk to Mr. C, unlike A? But is the entire risk on C, or is the risk on both the issuer and the holder? In this case, I would say the risk is completely on the issuer. In this case, I would say the risk is completely on the holder. But can I say in this case, the risk is getting divided, not equally, but can I say the risk is definitely getting divided? It's a situation between A and B. What kind of instrument do you think the company will issue to Mr. C? I'm sure I'm going to get now good answers on that. So in this particular case, I guess we got the answer. It's going to be a compound financial instruments, both a liability as well as a debt. I think that's wonderfully given by everybody, that this is going to be a compound financial instrument in nature. Super. So I think that's rightly said. I think everybody has understood the concept very well. Lovely indeed. So the company will say that, he's got some risk. So the company will say, we'll give you a compound financial instruments. Now I'm going to make a strong statement. Don't worry, we're working towards illustration 5 only. We're working towards illustration 27. And if the need be, this part of the portions which I'm covering, you can revisit on the YouTube once again. The video is going to be available, so you can always go back and revisit, and after your revisions, you'll get more clarity of thoughts. So in this particular case, I've understood one thing, which I'm going to make a statement which you need to vouch me. Can I say, if you give an option to convert, you will never give them the same interest which you would have given on a non-convertible instrument. If a company pays interest on a non-convertible instrument at 10%, I'll never pay 10% on an optionally convertible instrument. I'll always land up paying lesser than 10%. Agreed. You cannot have your bread buttered on both the sides and eat it too. So as an issuer, if I am issuing an instrument which has got an option to convert, trust me, I will never give an instrument the same rate of interest. If the instrument on a non-convertible instrument is 12, An instrument with a convertible option will always be below 10. And can I say that is what it will make it as a compound financial instrument? The very fact that the interest rate on an optionally convertible instrument is going to be below a non-convertible instrument, that will insert an element of equity that will make it a compound financial instrument. Am I making sense? Did you get my thoughts very clear? An optionally convertible instrument will never give the interest to the holder at the same terms which a non-convertible instrument gives. If I'm giving a 12% on non-convertible, I'll never give you 12% on a convertible. I'll pay you less because I'm giving you the option to convert. You get a better deal to take cash or shares at the end. So I'm going to cut down your interest rate, making it a CFI. I think you agreed with me. I hope I'm well connected on my dot so far. I'm absolutely well connected on my dot so far, and I get a big yes on that. That means that is 100% agreed. Super. Now I think it's time to visit back on the illustration number 27, and let's have a look at this illustration 27 once again. So we'll look at this illustration number 27 once again with a little more keen eye, looking at more facts in this particular case. Let's revisit. Now you're going to get the entire deal very clear. Now you need to see that optionally convertible instruments, are they CFI? Oh, yes. So can I say the non-derivative element is going to be a CFI? Oh, let's come back. So we are given in this particular case, I am given in this particular case, D issues preference shares and the holder has got an option to convert these preference shares to equity instruments at any time up to a period of 10 years. And if the option is not exercised, the preference shares are redeemed at the end of 10 years. Option to convert. So the option to convert now gives me two bells on my mind. The option to convert means it's a CFI. The option to convert means that there is a derivative embedded. Agreed. When I say option, there are two things which comes to my mind. Interest will not be paid at the same rate on a non-convertible. It is going to be a CFI option. It is a derivative in nature. You got the connect. Yes, sir. Let's go ahead now. So in this particular case, let me now come back on the inputs in this case. So we're looking at optionally convertible. In this particular case, it was preference shares, or it can be debentures, whatever, that doesn't make a difference. So we're looking at optionally convertible preference share. So the moment I see that it is optionally convertible preference shares, I'll say there are two things coming to my mind. Can I say it is going to be a CFI, and because it has got an option to convert, the option to convert is supposed to be a derivative in nature. The option to convert is supposed to be a derivative in nature. And this compound financial instrument is supposed to be, you can say, a non-derivative component. Wow. So I think these are the two inputs which we will immediately realize. Then when I say it is optionally convertible, immediately I'll say it is a CFI. That CFI is the non-derivative element. And in this particular case, the option to convert is the derivative element. So let's get this very clear. So once I get these input, now I'm considering the mode of payment to be shares. Now I'm considering the mode of payment to be shares. The next 5 minutes crucial. You'll get this data. So I'll say, okay, if the mode of payment is shares, then in this particular case, I need to apply a fixed test for this component. Because if it is a mode of payment shares, I need to apply the fixed test in this particular case. Now, one thing is very clear. A compound financial instruments will definitely get two elements. One is you are going to get the financial liability, and one is you're going to get the equity. How does the split accounting occurs? We'll see. How does the split accounting occurs? We'll see. So rather, let me not even call it as a fixed test. Let me not even call it as a fixed test. Let me just say that I will do the split. Let me say that I'll do the split. Because it is a compound financial instruments, I will split the FL and the equity component. Okay. And then I say it is derivative. Let me apply the fix for a fixed test in this case. When I apply the fix for a fixed test, if it passes, then I'll say it is equity instrument. And if it fails, then I'll say it is a derivative financial liability. So the CFI, so when it is optionally, it will definitely be CFI. Mind the words, if it is optional, it is definitely CFI. Splitting the financial liability and the equity. Now I need to do one thing. I am looking at now the combinations. So the non-derivative element is divided between FL as well as equity. The non-derivative is segregated in terms of FL as well as in terms of equity. And the derivative, if it becomes equity, there is no need to segregate. There is no need to segregate this. So which means if your derivative is equity, ignore it. Don't segregate it. Don't do the surgery. Don't take him out. I will get only two components of this instrument, FL equity done. Second, if you say this is FL and equity, you segregated them, and you say the derivative is supposed to be FL, then you need to segregate. Now don't ask me the logic at this stage. Why? The logic is still pending. The standard says that if there is a derivative which is equity, if it is derivative is equity, no need to segregate. And if it is supposed to be FL, then you need to segregate. So effectively in this case, you will segregate two elements of the component. And effectively in this case, you'll segregate three elements of the component. Is the picture getting a little better? Are you now able to get some connect that optionally convertible instruments are undoubtedly most of the times going to be CFI? And because of the option, they will have a derivative. And you will test the derivative for a fixed test. If the derivative becomes FL, I'll segregate. If the derivative becomes equity, I will not segregate. I'll be working on this element again later when I come to the accounting of a compound financial instruments. Did you now get the dots connected? We're going to revisit now illustration 527 once again to read the answer. But let me, I think, first get the inputs. Did you get the dots connected, friends? Are you able to visualize? I know this is technical. I know this is quite technical indeed, but I hope you got the dots connected on this. Wonderful indeed. So I think let's come back on the illustration number 27. Let's now read what is the inputs which is given. Since in this particular question, I am not given the interest rate on a convertible and on a non-convertible instruments, we cannot even decide that it is a CFI or not. But considering the lack of data, let's now read the answer. The instrument has got two components. What are the two components? Can I say the two components is non-derivative and derivative? The two components are non-derivative and derivative. So we can say the first one is supposed to be a non-derivative. It says the contractual obligation, but that is conditional. On the holder exercising the right to redeem. He may not redeem. He may or may not redeem. So it says there is a contractual obligation, but it is dependent upon the holder exercising the right to redeem, because he may exercise the right to convert, he may exercise the right to redeem, I don't know. But as an issuer, I've got an unavoidable obligation to pay. As an issuer, I've got an unavoidable obligation to pay, because if he says, I want shares, I'll say, okay. He says, I want cash, I will say, okay. So I've got an unavoidable obligation, but this time this unavoidable obligation is dependent upon the holder exercising the right to shares or cash. Then he says the second one, that is the second point, this is the derivative conversion option with the holder, which is the derivative. So on the basic level, there is a non-derivative component and there is a derivative component. Now, this non-derivative component to me and even to you would be a CFI on the logical presumption. Is that correct? Because if I look at this non-derivative element, to me, the non-derivative element will be a CFI, which is going to be split in terms of FL as well as in terms of equity. Why? Because I will not pay the coupon rate which prevails on a non-convertible instrument. So this would undoubtedly generally become a CFI. So this non-derivative element is going to become a CFI. Let's go further. So he says the first component is a financial liability. He said it as a financial liability because in this particular case, I'm not given the data to analyze that, what is the FL and equity, but I'm already telling you that generally optionally convertible instruments will be CFI. So the first component to me is going to be a CFI because the entity does not have the unconditional right to avoid paying cash. Then it says the other component, which is the derivative element. It says the conversion option is an equity feature. If, since again, I'm not given a data in the question to decide that is the fixed for a fixed test will pass or fail, he's given you two answers. He says it'll become an equity feature if the fixed for a fixed test is met. Though he did not say further, but if the fixed for fixed test is met, are you going to segregate the equity component of the derivative? No. I'm not going to segregate the equity component of the derivative in that case. Then he says if the conversion option does not fulfill the test. Second assumption, because the conversion ratio varies, the fixed for fixed test fails, then it becomes a derivative liability. In that particular case, are you going to segregate the derivative liability? Yes. So if the derivative fulfills the features of equity, I'll not segregate. If the derivative fulfills the features of liability, I will segregate. And then it says such an instrument is called hybrid instrument in nature. Now you can keep connecting the dots. So now we can see that if a company issues, so next time when you read the facts of the case, the company issues an optionally convertible instrument. My mind was telling me, okay, optionally convertible instrument means that the interest rate which I will pay is going to be lesser as compared to non-conversion. So CFI. Second, there is an option to convert derivative. Now let's apply the fixed for fixed test for a derivative. If it passes a fixed test, it's equity. I'll not segregate the derivative. If it fails the test, then it is a derivative FL. I'll segregate. And I've already penned down the thoughts. out here. That optionally convertible preference shares will be a CFI, which will be split into two. The option to convert will be a derivative, which will be tested whether it passes or fails the test. And in this particular case, if the test is passing, that means there is no need to segregate the derivative equity. But if it is failing, then there's a need to segregate the derivative financial liability, because this FL is non-derivative and this FL is derivative, so they will have a different accounting. Wonderful. Let me now ask you, friends, now did you get some corrects? I'm not saying 100%, but you would have got some dot connected. Now, derivative, non-derivative. We'll make some quick notes on this as well, penning down our thoughts. Did you get the input, friends, on that? So let me get your answers on that. Do we stand clear on the agenda? Are we clear on the inputs in this case? Okay, so I think so far so good. Yes, still very complex indeed. So no worry, we are going to make it a little consolidation level as well. Okay, I'm getting some input. So it's saying that optionally convertible instruments is only hybrid instruments. You can say that. You can say that if you say that we've got optionally convertible instruments, will they be invariably hybrid instruments? Yes, undoubtedly yes. Yes, I think I confirm that no other combination is going to be a hybrid instrument. The presence of option is going to be necessary to call it as hybrid in nature. I agree with the inputs on that. Wonderful indeed, friends. So now I think let's connect the dots. I know this must be getting very heavy indeed, but I said, after some time, you are going to get all the dots connected. So let's go further. I think I'm back on the agenda. It's time now to connect the entire things at one go. So this is Ind AS 32 going on, and we're yet to discuss the concept of compound financial instruments, the concept of split accounting for a CFI, which is going to be worked upon later, and there is that illustration 3, which is still pending in life. Wow. So let's do one thing now. We're just going to make a quick summary of the learnings. I think that's going to be very, very crucial at this stage. Because if we don't make the summary at this stage, it's going to be dangerous. And I think at this stage, it's important. So as I speak, you're welcome to give answers, or otherwise, keep hearing me and keep connecting the dots which are happening. I'm going to make statements, and you need to analyze and understand that statements as well. My mind is now working on a very interesting inputs. We'll be doing some quick summary mind maps later. As I said at the beginning of each sessions, I am going to also take you on a run through making mind maps as well, because I know this is a technical topic indeed, and that's why I love it. But trust me, things get technical at the same time, it becomes very interesting indeed as well. Okay, now watch this carefully. So I would say, if somebody were to say that, okay, what are the types of financial instruments? Not from the perception of liability, equity, or in terms of CFI. I think the first layer is to see that they're derivatives, non-derivatives, or they are embedded derivatives. Then I think the next layer is to see that it is FL, it is equity CFI. So get this thing very clear in mind. The approach of looking at instrument is based on a layer 1, and then it is based on a layer 2. Though we started a journey on the layer number 2, but by the time we reached the version number 3, we understood that the layer to be seen is, first of all, is that derivative, non-derivative. But we also understood one thing, that when is that important? So when you say it is non-derivative, when you say it is derivative, and when you say it is non-derivative plus a derivative, which is basically called a case of embedded, derivative in nature. So it's important now to see the larger steps. Am I going to decide? I'm now going to put some question friends to you, so please analyze this and give your answers as well. So I'm now looking at, am I supposed to decide always that whether the instrument is derivative or non-derivative or embedded derivative, or is that going to be relevant only if the mode of payment is shares? Decide. So when I'm looking at the concept of whether it is derivative, non-derivative, etc., when do I take these calls? Do I take these calls when the mode of payment is shares, or do I take this call even if the mode of payment is cash? And that's rightly given. So we can say undoubtedly that is correct. So only when the mode of payment is going to be shares, then I am going to decide this particular call in this particular case. Superb indeed. So I can say the first thing you need to decide is the mode of payment. If your mode of payment is supposed to be in terms of cash, there is no need to decide. There is no need to decide that the instrument is derivative or is non-derivative in nature. You can proceed. But if the mode of payment is supposed to be shares, then I definitely need to decide. Then we need to decide that is it derivative or is it non-derivative in nature. So this segregation is important depending upon the mode of payment. That's the first thing. So when you read the question, your focus is going to be on the mode of payment. And then you say, okay, the mode of payment is cash. Let me get relieved. And if the mode of payment is shares, then I need to decide it's derivative, non-derivative. Now, how would you decide that it is derivative or non-derivative in nature? Can I say to decide it is non-derivative and non-derivative in nature, we need to apply three parameters, which I gave you. We need to apply three parameters, which I gave you. Those three parameters will take you a call. If those three parameters are met, it becomes a derivative. And any one of the parameters fails, it becomes non-derivative. And let me give you some instruments. And you will decide and put them. So I'm going to give you examples. You tell me, is it a derivative, is it a non-derivative, or is it embedded derivative? I'll give you three instruments to decide. Mandatorily convertible instrument, compulsorily convertible instrument, ND, D, or ND plus D. I'm looking at now the input that I've got mandatorily, or you can say compulsorily convertible instrument, CCPS, MCD, mandatorily convertible debenture. So that is going to be what? And that's rightly given. So in this particular case, you can say it becomes non-derivative in nature. Very good. So we can say if you've got compulsorily convertible instrument, then you can say it is supposed to be non-derivative. Okay, let's give you the next one. Optionally convertible instrument. When I say it is optionally convertible instruments, so can I say if it is optionally convertible instruments, then in that particular case, what comes to mind is it ND or is it D or is it ND plus D? Optionally convertible debenture. I think you'll agree that it's going to be both. It is optionally convertible. If it is optionally convertible, it is both a case of derivative and non-derivative in nature because of the presence of the option. And if I just use the word options, that you're entering into an option contract, I think it goes without saying that if you enter into option contract, it is supposed to be, you can say, a derivative in nature. Okay. Now, concentrating on the mode of payment issues, I'm extending this chart. So if you say the mode of payment issues, can I say in this particular case, which test are you going to apply? If your mode of payment is supposed to be, shares in this case, and what test are you going to apply? You're going to apply simply the fixed test. You're going to apply simply the fixed test in this particular case. That's it. So now you also need to consider that if the mode of payment is shares, then you're deciding a fixed test. Now, one particular component is paid in cash, another component is paid in shares. All that is complicated, which we've already covered. But I'm just trying to tell you which test are you going to apply. So to the component which is paid in terms of shares, you'll apply the fixed test. And if it is derivative in nature, then you will apply which test? We will apply the fixed for a fixed test. We'll apply the fixed for a fixed test. And now comes the input, which is optionally convertible in nature. If it is optionally convertible in nature, can I point blank assume that the non-derivative is a CFI and test the derivative for fixed test? I repeat. Can I say if it is optionally convertible, can I go safe and say that the non-derivative element is going to be, a CFI and the derivative element can be tested in this case? Is that correct? I think yes. So in this particular case, we get the answer, yes, indeed. That's wonderful. That's wonderful. So I'm getting good answers on that. That is great indeed. Super. So in this case, we can safely go with the input that as far as the non-derivative is concerned, it's going to be CFI. And as far as the derivative is concerned, we need to apply the fixed for a fixed test. we have to apply the fixed for a fixed test in this particular case. And if it is a CFI, you'll end up splitting this between the two elements. One is the financial liability and one is the equity. How do you do the split? That we'll see later. Now the final inputs at this stage. When you apply the fixed for a fixed test, can I say and it becomes equity or it becomes FL? If it becomes equity, will you segregate or will you not segregate? If the option has got the characteristics of an equity, are you going to segregate the equity in this particular case? The answer is no. And in this case, will you segregate? The answer is a yes. So this instruments will either have two elements, FL equity, or it'll get three elements, FL equity, non-derivative FL and a derivative FL. The reason is the derivative FL has got a different accounting and the non-derivative FL has got a different accounting. Wow, from where we reached where? We started the journey on the version number 1, which was based on the concept of just applying the thoughts on the mode of payment. And then we went to the version number 2, amended the concept of looking at cash and then deciding. And then we went to the concept of introducing a version 3, where we started looking at the macro level, the instruments of derivative, non-derivative, and a case of embedded derivatives. And in which particular cases we start deciding that which tests are to be applied, and then we come to the conclusions in this case. My sincere advice, friends, you need to sit down and make your complete concrete revisions on this part. Maybe there need be, watch this class, maybe at a 1.5x. That's what we generally do. So just watch this and get the dots connected very well. And trust me, you will feel super duper clarity in terms of things. Because once you do the cumulative revision 1 and 2, now you've got 2 classes. Once you revise all that, trust me, you're going to get the dots connected very well. My illustration number 3 is still pending. That is on the perpetual debt, which is going to be the focus next class. In the next session, we're going to first of all discuss that perpetual debt. I need to give you that input, which I'm going to discuss along with CFI. That illustration 3 will be blended with the concept CFI. So the next focus point in the next session is going to be typically on the concept of CFI. So I'm going to focus completely on the compound financial instruments with you. I think that seems to be quite good for the day. I know your mind must be tired as well. Okay, so that's all, friends, from my side today, unless you've got any questions to ask me. Right, friends, I think seems to be nothing so far. So I think that's all for the day. It was wonderful interacting with you. So see you in the next class with your revisions, cumulative revisions on. So I think that's all for the day. I think, let me see some message coming. So that was very enlightening. Thank you very much indeed. Thank you very much. Thank you all of you once again, and see you in the next class. Thank you. Bye-bye, and take care. Thank you.